just curious to get like your high level perspective on the labor market and whether this just aggressive Fed put that's struck underneath the labor market is it like warranted at all? What are they missing that you feel like is not warranted for that?
Well, I mean, first of all, from a level perspective, you know, I'm old enough to remember when 4% unemployment rate was considered a very strong labor market, or where prime age employment being at 25-year highs means that the labor market's pretty strong. And so, I look at those numbers and I say, yeah, we've gone from where we were in 2022 and early 2023, where the labor market was like incredibly hot, like red hot, to a labor market that is, strong. And to be clear, Chairman Powell in the meeting said the labor market is strong probably a half dozen times. So it's not like there's a disagreement about the fact that the labor market is strong. Um, what he's saying is that he wants to maintain a very strong labor market. I think in part because he doesn't see any risk on the inflationary side of things, or de minimis risk on the inflationary side of things, even despite cuts. And so I think that general consensus, like from a level of the labor market, I think mostly, most people are aligned. Most reasonable people are aligned with that view. I think the thing that is a real interesting question is a strong labor market supportive to inflationary pressures? And I think there's a meaningful disagreement, where what Chairman Powell's thinking is to look at level indicators as they compare to level indicators in 2019, and which was a time when the labor market was strong, but wage growth and inflation was at target, and say, hey, look, we're at the same sort of level as we saw at that point in time, or close to it, depending on your measure. Therefore, there was no inflation pressure back then from labor markets, so there must not be inflation pressure today from it. And the problem with that thinking is it misses the fact that prices have gone up 30% in the last 4 years. And so labor market conditions at the same level of tightness today have a totally different perspective in terms of what is appropriate nominal wage growth to maintain, real purchasing power. Totally different perspective than it was in 2019. Now, why he doesn't see the difference between, wages today and pressure on wage growth before, I don't know. But today nominal wage growth is 5%. That is
Mhm.
very high unless you have extremely high productivity growth,
Right.
and most likely creates, structural inflationary pressures that will, keep inflation above the Fed's mandate.